Okay, hello students. In today's lecture, we are going to continue our discussions about a firm's payout policies. So let me share the PowerPoint slide. Okay, so recall from the last lecture that in a perfect capital markets, the payout policy does not matter. In other words, if the world is perfect, investors do not have any particular preference between the share repurchases and cash dividend, and therefore a firm's payout policy does not affect firm's value either. Okay. Well, but in reality, we have a lot of imperfections, right? We are embracing a lot of imperfections. Therefore, in reality, it's very likely that actually the payout policy does matter, okay? The choice between the cash dividend and stock repurchases. Just as with the capital structure that we had learned from chapter 16, taxes is once again a very important imperfection that affects the firm's payout policy. So therefore, we are going to investigate the firm's payout policy and how it affects firm value and investor preferences with the presence of taxes. Okay, so please remember from chapter 16 that tax differently treated payment to debt holders and payment to equity holders. Therefore, with the presence of taxes, our capital structure had a bias toward more debt financing. Something similar happens here as well. Under the current tax code, the dividend income and homemade dividend income are taxed differently. So when a firm pays a dividend, a cash dividend, actual dividend, shareholders are taxed according to the dividend tax rate. Okay. But if a firm does stock repurchases instead, remember that investors don't receive any cash immediately at all. But if the firm decides to do repurchase and if the investor think they want to have a cash, they can create a homemade dividend by selling some of their shares, as we learned from last lecture, right? So when a firm does repurchase and shareholders combine that with a homemade dividend, this homemade dividend, the fake dividend income, will be taxed according to the capital gains tax rate, because although we call them homemade dividend, that's actually capital gains that investors realized by selling their shares. So whenever investors sell the shares and create some cash proceeds from selling of those shares, they are called capital gains, and the capital gains are taxed according to the capital gains tax rate. Okay, so remember that when an actual dividend is paid, it will be taxed according to the dividend tax rate. And when the firm does repurchases instead, and when the shareholders create homemade dividend by themselves, then those homemade dividend incomes will be taxed according to the capital gains tax rate. So now the question is whether these two rates are equal. If the two rates are equal, maybe we don't need to care, but if one rate is higher than the other, the firm has to go for the lower, the firm has to go for the tax policy that leads to lower tax rate at the individual investor level. Okay, so what do you think, which tax rate has been higher, you think, historically? So this chart shows you the historical capital gains rate and dividend tax rates in the US for the highest income bracket investors, okay? And also this is for the qualified dividend income and qualified capital gains income, okay? So as we can see, well, although this is for the highest income bracket investors, historically, the dividend tax rates have been much higher than the capital gains tax rate. Okay, for example, in 70s and 80s, dividend tax rate has been as high as 70%. it means that if you get $100 as a dividend income, $70 will go to the IRS and you only kept $30. Yes, that was true in 70s and 80s. Over time, the huge gap between the capital gains tax rate and dividend tax rate have been tapered down. And starting from 2003, with the new tax code, the two rates have been equated. So since 2003, capital gains tax rate and dividend income tax rate have been equated. Okay, right now for the highest bracket income investors, both rates are 20%. Okay. All right. So you may say that, okay, we understand that historically dividend tax rate has been higher than the capital gains tax rate. Therefore, it's true that historically stock repurchases had tax advantages over cash dividend. But now that the two tax rates are equated, investors don't care anymore. So we are going back to the perfect world outcome again. Well, that is not true. Actually, even with an equal tax rate, even though capital gains tax rates and dividend tax rate are the same, there is still a tax advantage for share repurchases over dividends because of two reasons. First of all, if you create a homemade dividend, if the firm does stock repurchases and you create a homemade dividend by yourself, you get taxed only on the profits that you have created. Okay, well, if the cash dividends are paid instead, the entire gross dividend income will get taxed. But if you create the same cash amount by creating a homemade dividend, then you get taxed only on the profits that you have made. So here the original purchase price that you paid becomes mattering, okay? But you only pay taxes on the profits that you have made, not the entire gross income that you created, okay? So by design, if you are creating the same amount of gross cash amount from the homemade dividend, you're even at the same tax rate, your dollar amount of tax will be smaller under the stock repurchase scenario. Okay. Second of all, for the long-term investors, if you are a long-term investor, therefore you don't need to raise cash immediately, you can effectively defer the capital gains, and therefore you can defer the capital gains taxes as well. Okay, well, this is at a stark comparison with a cash dividend. Recall from the very first lecture on the Chapter 17 when we compared how dividends are paid and stock repurchases are made. When the dividends are declared, there are 4 dates, right? So on the declaration date, dividends are declared, and the company will go on to take the record on a record date, and on the payout date, the actual paycheck will be mailed out to investors, right? In other words, once dividends are declared, and if you happen to be investors of record on the record date, in some sense, you cannot avoid not receiving the dividend. You will receive the dividend according to the set schedule, and you will have to pay taxes in a specific year that you have received the dividend. But when it comes to stock repurchases, you have discretion over the realization of your cash proceeds. Okay, so to create a homemade dividend, you have full discretion over the timing of realization, right? So you can create the homemade dividend whenever you want. And if you do not want or need cash immediately, you can defer the capital gains toward a certain future date, and therefore effectively you can defer the tax payment. Then now, if we are paying the same amount of tax, which one would you prefer? Paying $100 tax today versus paying $100 taxes 5 years later? The time value of money tells us that with an equal amount of tax amount, if you can defer that toward a certain future date, that's more valuable, right? So due to these two reasons, first of all, for the homemade dividend, you only pay taxes on profits that you make, not the gross income, and you have ability to defer the tax payment. So even with the equal tax rate, there still is a tax advantage for stock repurchases over dividends. Okay. Then, what would be the optimal payout policy at the presence of taxes? So, when the dividend tax rate exceeds the capital gains, surely optimal payout policy will be not paying any dividend at all. And even when the two rates are the same, even when the dividend tax rate and capital gains are the same, under the current tax code, due to the two reasons that I have explained 1 minute ago, still optimal payout policy will be paying no dividend at all. And whenever the firm needs to pay out cash to its shareholders, it has to do so through stock repurchases. Well, then how does the payout policy in practice look like? Far from the prediction of the theory. So dividends in practice. Prior to 1980, most firms used dividends exclusively to distribute cash to shareholders. This is shocking given the fact that, as we have seen, before the 1980s, the dividend tax rates have been as high as 70%. Meaning that when the firm pays a $100 dividend, $70 will be taken by IRS and only $30 will be left in the investor's pocket. Even with this clear disadvantage, prior to 1980, most firms used dividends exclusively to distribute cash to its shareholders. Over time, we are seeing that the popularity of the dividend is decreasing and the proportion of stock repurchases increasing, as we can see from this chart. So over time, the proportion of payout made through stock repurchase is increasing and the popularity of the dividend is decreasing, but still, big chunk of firm is relying on dividend as it's the form of payout exclusively. So by 2015, about 40% of firms relied exclusively on dividends. Okay, so this is pretty puzzling. So the researchers call this phenomenon a dividend puzzle, which refers to the fact that firms continue to issue dividends despite of their clear tax disadvantages, right? Okay. So we have learned that so far with the presence of taxes and under the current tax code, cash dividend is inferior to the stock repurchases, and stock repurchases have strict tax advantages over cash dividend. Therefore, the theory's prediction is that optimal payout policy is choosing stock repurchase over cash dividend all the time, but the reality is far from that. So how do we reconcile the theory's prediction and the reality? Well, one explanation is the tax differences across investors at the individual investor level. So although we have said that on average, average investors will prefer stock repurchases over dividend, that's the strength of that preference could be varying at the individual investor level, depending on many factors, including income level, investment horizon, tax jurisdiction, and the type of investor or investment account the investor is holding. Okay, well, it's not an exaggeration even when I say that each individual investor faces a unique tax function. The tax calculation is that complicated, so there's no reason it's not surprising why tax accountants make a lot of money, and we even very informed investors, they hire tax accountants. Tax calculation is very complicated, and there are so many different factors that uniquely design each investor's tax function. Okay, and the four factors are the most common big factors that affect individual investors' tax amount. Okay, so as we know, in the US, tax rates vary depending on the investor's income level. So the investor's income level will be one important factor that affects investors' tax preference. And also, investment horizon matters too. The tax rate chart that I had shown you before, that is for the qualified dividend income and qualified capital gains, which means that you had to hold the stock at least for 1 year. Okay, if you are receiving dividends from the stock that you have not held more than 1 year, your tax rate will be higher than what is listed here. So investment horizon also affects investors' tax rates as well. Okay, and also tax jurisdiction will affect your tax rate as well. Whether depending on you live in California versus Washington or New York, your tax rate will be different. Okay? And who you are also matters. Some investors are tax exempted, and some type of investment accounts are tax exempted. For example, the money that you put into your individual retirement account, they grow without tax. Okay, and also the money that you put into your college savings account, they grow without tax. So depending on who you are and what kind of investment account you hold, your actual tax function will be varied. Okay, so although we said that on average, investors will prefer stock repurchases over cash dividend at the individual level, and depending on their unique situation, their preference could be varied. So some may prefer dividend actually, and some may be indifferent, and some may be preferring stock repurchases. Okay? So as a result of their different tax rates, investors have varying preferences regarding dividends, and generally, individual investors with high income and long-term investors, they tend to have preference for stock repurchases over dividends. And short-term investors or tax-exempted investors, they have no tax preferences because they're tax-exempted anyway, or they will, for the short-term investors, they will face a high tax rate anyway, so they have no tax preferences. In this case, they will just prefer payout policy that most closely matches their cash needs so that they can minimize the transactions. There are certain types of investors who actually may prefer cash dividend. The most popular example is corporations, corporate investors. For example, say you are an Apple company and you have a lot of cash in your pocket, and if you use that cash to purchase the stocks of other company, and as a result of that investment, if you receive cash dividend as a corporation, then your dividend income, 70% of your dividend income will be excluded from tax, which is called 70% exclusion rule. So if you are a corporate investor, then you have a strict preference for cash dividend over stock repurchases. So one theory says that there is something like clientele effect, which refers to the situation that the dividend policy of a firm is optimized for the tax preferences of its investor clientele. To put it simple, clientele effects means that the firms that is paying cash dividend right now, they have chosen to do so because their current investor base is people who prefer cash dividend over stock repurchases. And also, firms that are choosing stock repurchases over cash dividend, they have done so because their current investor bases are those preferring stock repurchases over dividend, simply put, okay? So there are some supporting evidence for the existence of clientele effect. For example, individual investors, they will prefer share repurchases over dividend, and they accounted for about 52% of the stock market. but they only held 30% of dividend-paying stocks, meaning that individual investors had a preference for stock repurchasing stocks than dividend-paying stock. Although the evidence is not perfect, okay, but there are some supporting evidence for the clientele effect. Okay, so well, as we have seen, still, although there is evidence for the clientele effect, it's not perfect, which indicates that tax may not be the only and the most important factor in determining the firm's payout policy. Okay, so we are going to, in the next chapter, in the next topic, we are going to investigate the impact of other imperfections like that as well. For now, let's summarize the differences between the dividend and stock repurchases. Under the dividend, the cash payment is directly made on a per share basis to all existing shareholders on the record date. As opposed to that, when the share repurchase is declared, there's no direct cash paid out to investors. Rather, the firm will use cash to buy back its shares, and only the investors who decide to offer their shares will be participating. Okay? So in terms of the participation, when it comes to dividend, the participation is involuntary. In other words, everyone with a share will receive a dividend. However, when it comes to share repurchases, the participation is voluntary, and shareholders who chooses to sell their shares will be participating. Okay? When it comes to taxes, dividend income will be generally taxed as ordinary income, and when the share repurchase is done and the investor makes homemade dividend, that income will be taxed as capital gains. Okay. Well, the effect on share price is still same as what we have seen in the perfect capital market. When the share price, when the dividend is done, stock price will drop by the amount of dividend on the ex-dividend date. Well, as opposed to that, when the share repurchase is done, it will have no effect on share prices as long as the shares are repurchased at a fair market value. Okay, so when it comes to effect on share price, whether the tax exists or not, we still have the same outcome. When the dividend is paid, stock price will drop by the amount of EPS on the ex-dividend date, and when the stock repurchase is done, the stock price will be unaffected by that.